Welcome back, guys. Today I wanted to jump in and talk about exit criteria for knowing when to actually exit and remove capital from a liquidity pool. And interestingly, some of the criteria we're about to look at are important criteria to consider when we're entering a pool, but also important to consider as we monitor progress and think about exiting a pool as well. So let's jump in and talk about it. There's 5 different criteria that I want to discuss today in the video, and the first one is around invalidation levels. What do I mean by this? Well, essentially, when we're considering getting into a pool in the first place, we should be thinking about potential invalidation levels ahead of time. This means that we want to think about a particular price or area that price might drop to where we say, okay, enough is enough. If the price action breaks this particular invalidation level, then I'm going to consider actually removing my capital from the pool. So let's look at Ethereum here for a moment. And of course, we've got the benefit of hindsight using this particular chart. But if you happen to be getting into an Ethereum liquidity pool, let's say WETH USDC, back here in either December, January, possibly even February, you want to think about the potential invalidation levels or key levels of support that could break that would trigger you to think about actually exiting the pool. Okay, of course, if we were up here during this time frame, we didn't know price was going to come down to these levels around 1800. However, we could see that there was 2 very important key levels of support, in my opinion, during this time period. That first level of support was going to be the 200-day simple moving average. Okay, we were sitting nicely above the 200-day simple moving average for all of December and all of January until we got to the very beginning of February and broke down. But you might have said to yourself, I'm going to provide liquidity here until Ethereum breaks down below the 200-day simple moving average, and that's my get out of the pool trigger to say, I don't want to actually provide liquidity if we break this key level of support, because if we break this very key level of support, it's likely that we could come a lot lower here in terms of price. And if you do that, you might say, I'm going to get out of the pool here if we break this level and actually re-enter once we find support at a lower point in time. Okay, again, we've got the benefit of hindsight, so it's important to consider that in this particular example. But zooming out even further onto the weekly chart here for Ethereum, you can see that we did actually break another very key level of support even more recently. We had this key level of support, this trend line on the chart here. If I go all the way back to, 2021, we had this key level of support holding here on multiple occasions over the course of the past 4 to 5 years. And just very recently, at the beginning of March, we broke below that key level of support. We can see that on the daily chart as well, but you could have been thinking to yourself, okay, if I do my macro technical analysis and I can see these long-term trends, I want to say that, okay, if Ethereum breaks below this long-term trend, then it's likely to be able to come lower because it's a very long-term support line. So again, you can see that we broke below that level around 2200 here at the beginning of March, end of February, and we did continue to come even lower. Okay, this is what I mean by invalidation levels, and thinking about invalidation levels at the point at which you're getting into the pool to say, okay, if price breaks these very key levels of support, it's likely to continue lower. So that might be a good point for me to remove my capital and wait for a lower re-entry. Again, there's lots of other things to consider here. Yes, you might have some impermanent loss. We never really want to lock in impermanent loss if possible. But if you have the opportunity to buy in even lower, if those key levels of support are broken, it could actually end up being a more profitable trade in the medium to long term. The second criteria I want to take a look at here is a drawdown of 30 to 40%. Again, this number can differ for any of you depending on what you actually want to think about in terms of the type of drawdown on a percentage basis that you are comfortable with. But you might just happen to say to yourself, okay, I'm able to tolerate a drawdown of 30% before I would consider exiting the pool. And again, this is dependent on your fundamental thesis on the asset, because we do advocate for simply getting into liquidity pools that we are fundamentally bullish on. So you should be able to think about stomaching a 20, 30, maybe even 40 or 50% drawdown in the price of the asset as you're providing liquidity, because ultimately the reason you got into the pool in the first place is because you're long-term bullish on the underlying assets in that pool. But maybe everyone has a certain point that they think about saying, okay, that's enough of a drawdown for me. I don't want to continue providing liquidity if it draws down more than 30 to 40%. And that would be an exit criteria for me to actually remove my capital, and price might continue coming lower. It might bounce. You have to be okay with either of those scenarios playing out in the short or medium term. The third component I want to look at is the total value locked, okay? TVL is very important when it comes to us thinking about the criteria for getting into and out of liquidity pools, okay? I'm going to look at a couple examples here because I was exploring some different pools, and I brought up this WETH USDC pool on the Arbitrum network on Uniswap, and I was bringing up the chart to take a look at this and the actual price action happening. So this one here, actually, if I copy the pool contract, I can bring it over and paste it directly into Deck Screener. But what I want to do is I actually want to think about the volume that's happening here on the chart. And we can see that directly on Deck Screener. It gives us a good insight into the actual the TVL of the pool and what's happening here from a liquidity standpoint. We can see the TVL, or the liquidity on this particular pool, is about 268,000. The point I want to make here is that if you get into a pool when the total value locked is maybe around $1 million and it continues to move to the downside and continues to diminish over time, that is a signal that you might want to consider actually exiting the pool. If liquidity drops to a quarter of its original level, that might be enough for you to say, I actually want to exit this pool because liquidity is drying up and I don't want to be continuing to provide my liquidity in here when there's possibly other opportunities that I could be looking at. Again, if liquidity starts to dry up in a particular pool or fee tier, it can often mean liquidity is moving from that fee tier into a different fee tier for the same trading pair, and there's an opportunity to be generating significantly better yield, even on a similar or the same asset pair, but just at a specific different fee tier. So that's worth monitoring and considering over time. If I saw liquidity diminishing week over week and month over month over a long enough time period, maybe 30, 60 days, if it continues moving to the downside, that would be my trigger to say, I'm going to remove my liquidity and I'm going to move it to a pool or a fee tier where I can generate better yield because there's more liquidity and more volume happening there. And volume is that next key indicator that I'm always monitoring for pools where I'm providing liquidity. I'm looking at the volume, but more importantly, the volume to TVL ratio. Okay, again, we can see this by monitoring different pools. And again, I like to come over to Crystal and use Crystal as a way to sift through and shortlist pool opportunities because it gives me some good insights into the 24-hour APR, a quick snapshot of the TVL and volume. But even deeper than that, I like to click on this button here, which opens up the pool analytics directly on Uniswap and shows me the volume trend over time. Again, this is an ETH USDC pool on the base network on Uniswap, and I want to draw your attention to the pattern here on the chart. You can see there was a big run up in volume here through Q4 of 2024. It peaked around the beginning of 2025. And volume has continued to move to the downside thereafter. Again, this is not the type of trend I want to see in a pool where I'm providing liquidity. If this trend continues moving aggressively to the downside, as it is here, that could be a signal for me to actually remove my liquidity and look for a better pool opportunity where volume is more consistent. What do I mean by more consistent volume? Well, you can see here, this ETH USDC pool on Arbitrum over on Uniswap, this picture of the volume here over an extended period of time is painting a much more consistent picture. Again, this volume is sustained and consistent, not over just a couple of days or weeks, but over an entire year here. We can see that there's very, very consistent volume at this 0.05% fee tier for WETH USDC on the Arbitrum network. Again, you can zoom into different timeframes to see that volume pattern, but this is very nice consistent volume, and I'd rather be providing liquidity to a pool where I can generate very consistent fees, because consistent volume typically equals consistent fees, versus providing liquidity into pairs where you're going to see a big spike in volume. And yeah, you might get amazing fees for a handful of days, but if that volume begins to pull down, you're going to see your fees diminishing. and you're not going to be generating very consistent yield. So that would be another trigger I'd look for in terms of exiting a pool, removing my liquidity to provide it elsewhere. Okay, the final piece on our list here, or criteria number 5, is the opportunity cost. You have to consider the opportunity cost of reallocating your capital, even when you might have a small bit of a loss on that particular pool. You might have some impermanent loss, the price might have pulled back of the asset, but I do have a very quick prompt or framework to help us think about how to assess the days to break even if you do decide to close out a pool that's in a loss and reallocate that capital into a new opportunity. If you want this particular resource, again, we've got tons of resources here, check them out as well, but you can see here that we've got assess days to break even when reallocating capital. So essentially what we're doing here is we are putting this prompt into ChatGPT. I'll show you an example now in a moment, but we're putting in our initial deposit capital into the initial pool. We're putting in the current pool value and the amount of fees that we've generated from that pool during its lifetime. And again, we're using this to compare and make a decision about, is it worth us actually reallocating our capital, exiting our current pool and moving that capital into a new pool where we're going to generate, maybe better APR. So you plug in the estimated APR that you're going to generate in the new pool, and this gives us a way to think about that impermanent loss and what type of yield we could actually make. But more importantly, how many days is it going to take us to break even if we're in a loss in the existing pool before we get to profitability and start generating better fees in the new pool. So you can see here in ChatGPT, I plugged in a very simple example where I started off with $5,000 in my original pool. That pool value is down to $4,000, so a 20% loss, but I've made $450 in fees over the lifetime of being in the initial pool. I'm estimating that I'm going to be generating 110% APR from the new pool opportunity with concentrated liquidity. And again, the idea is that in my existing pool, I'm not getting close to that 110% APR anymore. So once we plug this in, we plug in those variables into ChatGPT, we can see that ChatGPT is telling us, doing the calculations, and we're going to take around 46 days for us to break even if we deploy our capital into the new pool. And then from 46 days onward, we're going to be into pure profit mode. Of course, we cannot factor in for all the variables with that new pool opportunity because APR will fluctuate. There's other factors at play, but it's going to give you a quick reference point for how many days would it actually take me to break even if I reallocate my capital, so that I can make an informed decision whether I want to keep my capital in the existing pool, wait for price to bounce to recoup that impermanent loss, or if I should reallocate, exit my current pool because I'm going to generate better fees in the new pool opportunity and I'm going to get to break even within 15, 30, 45 days, etc. So they're the exit criteria that I think about when I'm providing liquidity, guys. I hope that's helpful. Make sure to drop any questions below this video. Again, if you want more video content about these particular topics, we want more ideas in the comments. We've got tons of content coming, so make sure to subscribe, and we'll catch you in the next one.